company, as you know. This headline in Barron's really got to me because I love the simplicity. The biggest risk to the Mag 7 is how well they're doing. And now that Tesla's doing well and just scored, or it looks like it's going to score its 10th consecutive gain, it's up almost another 5% today. They're doing well. They're all doing well, and they're all making money for their shareholders hand over fist. Thomas Hayes back with us, the chairman and managing member of Great Hill Capital. Tom, you don't want to get in the way of a parade like that, but by the same token, the longer you hold on to these issues, the more they take up your portfolio. That might be fine when they're going up. It might be risky down the road. How do you play that, or how do you tell customers how they should play that?
Well, Neil, the theme of the first half, 60% of the gains in the S&P 500 were attributable to just 5 stocks. In the second half of this year, that's going to be flipped upside down. The plates are going to move under the surface without causing an earthquake. I know a lot of people are worried about a big correction. That's not going to happen. What we're going to see is the unmagnificent 493, yes, I coined that, are going to outperform the Magnificent 7 in the second half. And there's 2 key reasons for this, Neil. Number one is earnings composition. Q2 is going to be the first quarter since 2022 that the unmagnificent 493 have positive earnings growth. And by Q4, unmagnificent 493 are going to grow earnings 19% versus the Magnificent 7 only 17%. So that's reason number one for the sea change.
Very interesting. Of course, referring to the S&P 500 and the 493 that could not keep up with those 7, that might start reversing. That's an intriguing development because it could at least level things out a little bit. How do you feel about technology in general? And, a lot of people have been buying technology ETFs, NASDAQ ETFs, the ETFs that mirror the performance of some of these big names. Overdone or just about right?
I think it's not overdone if you look out long term. I think in the short term, some of these stocks have gotten ahead of themselves, and I don't think they have to crash in the second half. I know everyone's comparing NVIDIA to Cisco, but I do think that there'll be flatter performance, and you're going to see some of these laggards, kind of the last shall be first theme in the second half. And the second part of the reason for that is the Fed is going to cut, and that's going to enable some of the cyclicals, some of the dividend payers. Small caps earnings growth is accelerating into 2025, and REITs and international will be able to outperform. So maybe you see less of a performance in the indices, the market cap weighted indices for the second half, but you see dramatic opportunity under the surface where some of these laggard stocks really start to gallop, kind of like we saw the last 2 months of 2023. Just
to be clear, you're talking about the REITs Real Estate Investment Trust. You like them in this environment?
I do. We own Crown Castle, which is a tower company.
Absolutely.
They're anything interest rate sensitive. I think once we get that first cut in is really going to accelerate. They've underperformed because of this aggressive tightening cycle.
Good stuff. As always, Tom, great seeing you again as well. Thomas Hayes, the chairman and managing member of Great Hill Capital, knows of what he speaks. That's an understatement. And so does this next gentleman.